and in the UK, as well as Investment Management Limited in South Africa. She holds a BSc in Chemical Engineering from the Obafemi Awolowo University, Ile-Ife, in 2004, and an MBA in Finance from the Wharton School at the University of Pennsylvania. She is a CFA charter holder and an active member of the CFA Societies of Nigeria and Philadelphia. Powerhouse. Abimbola is married to a fellow great Ife engineer and is a mom to three toddlers. Sisters, please join me to make welcome Abimbola. Please, round of applause, please. Put in your emojis, the fires, the loves, everything. Like Abimbola, thank you so much for joining us. We are very, very excited to have you here. We feel so blessed. I mean, after reading your bio, I'm sure people could understand why it was so difficult for us to get you. At some point, we thought of calling the president of the USA, but we're like, okay, let's just chill. Let's just talk to
I
the
don't feel like that.
So please, Abimbola, over to you. Take it away.
Thank you so much. And it's a pleasure to be here. And I know I was very, very difficult to find, but trust me, it wasn't anything to do with the qualifications or the titles. It's all about the children. Honestly, I just like this time last year, I had 3 under the age of 3. This is a community of women. So I'm sure many of you know what that means. So sometimes I just feel like I'm drowning, trying to do that and work. I'm just like holding 10, batons for relay. And I'm like, so long as one doesn't fall down, it doesn't matter, So I'm always very thankful to be able to take an hour out that I'm doing something that's not related to my job, it's not related to my children. So trust me, you guys are helping me today feel like a human being. So I'm very happy to be here. The beauty of it is that we're talking about a topic that I'm so passionate about. Sometimes I joke. So how did I even get here, right? Nika Adebola, who is from your community, was my classmate in Ife. We studied chemical engineering together. And again, in Ife, I felt like I was drowning. I don't know who sent me to engineering. My calling is finance. So as soon as I found my calling, I realized I actually do have a talent, and this is something that I enjoy doing. This is all I know. This is all I've ever done. So really, really happy to share some of these things I've put together today. I would say that I can promise you that we can have a rich conversation, very open. Don't look at the beauty of my slides. Don't look at the formatting. Don't look at the content. I'll try to make sure that I touch on everything, but I think that perhaps the Q&A will be very rich, and I'll touch on what I think, are like the key important issues. I had like pretty much 24 hours to put those slides together. So I know that they're not perfect in terms of sequencing and all that, but it's the content that matters, not the packaging. So let's go. I'll share my screen. So I work at ARM Pensions. In that role, we're discussing this issue every day around kind of how do you prepare it? And it's not just about retirement. I didn't always invest in the pension space. I've invested outside of the pension industry, but it's the same thing. So it's always really very sad when we start to talk to retirees and we find out, and most times the people that are still working, that are our clients, we don't engage with them at all. They don't come, they feel like they don't have any business with their pension fund. Like, I'm working with my business with pension. That's in the future. Then when retirement is a year away or a couple of quarters away, they're like, oh, I need advice, I need to know what to do. And most people are just so unprepared, and it's quite sad. So whatever we can do to boost financial literacy, half of it is our own jobs to do for ourselves, but also whatever we can do in whatever communities we find ourselves in. I think very important that everybody's doing that, even for children. You'll be surprised how financial literacy is so poor. Honestly, and I'm not talking about basic, I'm talking about even people that are in very, very senior executive positions that are doing well financially, but just don't know how to kind of make financial decisions, how to quantify risk appropriately, how to make sure that you are compensated for whatever risk you are taking. I find that skill can be quite lacking in a community. So sometimes I've heard people tell me something like, oh, I got a loan, it's just 2% per month, or it's 3% per month, or something like that, and it's so cheap. And I will say, have you thought about what that means on an annualized basis for a year? Do you know, like, have you figured out what the effective interest rate is? You know, just being able to think that basic. So hopefully we can get through some of those things today. Some of the slides I'll skip through because these are slides we use in a lot of forums that we don't necessarily have to go base level. But I think basic questions you have to ask yourself, and you can take away retire and put something else in there. Whatever your milestone event is it when do I want to buy a house, or when do I want to kind of fund, you know, at what age are my children going to college, for instance, if what's on your mind is children's education plan, or if it's retirement, when do I want to retire? What level of assets do I want to have at that point? What do I want to be doing? And where do I want to live? On the top of it, a lot of the when do I want to retire and what level of assets do I want to have basically drives what you should be doing today, right? The where do I want to live and what do I want to do is now on the cost side. Like, how much assets will I need to retire if I want to retire in Lagos versus if I want to retire in Ilorin, for instance? They're not really the same. Yeah, what sort of things should I be putting together? So if I decide that I want to retire and what I want to do is travel the world, it has completely different implications from I want to retire and be farming, you know? So you need to have clarity around some of these things. The second thing people say is, I need to be saving more, I need to be saving more. And it's a misconception. And, you know, I saw on your chat, or someone has said Basbos to Esusu and Ajo and things like that, and we'll get to that. It is in the bid to save that people do Ajo, or it's in a bid to answer some of those questions I raised earlier. People say, I want to save more, I want to save more. But who has ever gotten rich by saving? Saving, what you want to be doing is investing. Saving and investment, they are not the same. Saving is just putting money away, and inflation is eating away at the purchasing power of that money. So it's a nice first step. Some of us are not even doing any, we're not saving, we're not investing. That's a problem. But if you are saving, you need to kind of go the next level, which is saving is not solving your problems. You need to be actively investing, either on your own or using professionals that can help you do it. And it's not rocket science. Many of our parents are even better investors than us if you think about it. You know, they've got this eye for risk. You'll see, you know, mothers when you were young, they're trading, they're doing this, they're doing that. Like, that money needs to be generating something. It can't just be money in a target savings account. And the typical savings products that we use, they're good, but they don't protect you from inflation. The holy grail is for you to be protected from inflation, because that's what eats away at the purchasing power of whatever money you're putting aside. The second very critical issue, and I will show you 2 slides just to illustrate this point, because I think people really underestimate how important it is to start early. The main thing you get out of investment is time value. So let me just go to those 2 slides before. You saw this already in your group, so I'm not going to stay there, but many of us are on this table, even me that I'm talking, trust me, we're all work in progress. Many of us are not prepared to lose whatever our primary source of income is. And we're not young. In your 20s, maybe that's okay. In your 30s, once you're 40 above, you cannot be in a position where you feel like, if I lose my job, is ground zero. Of course, it's a difficult thing for anyone, but you should have a buffer. And that buffer cannot be savings. It should be something that is yielding something, you know? And so you might have a drop in income levels, but you should not be in a situation where, if I don't have a job, you know, my income goes to zero. That's not good. So why do you need to plan? I don't think we need to spend any time here. So this chart, this one and the next one, very interesting. Can you guys see the slides clearly? And I can go to presentation mode if it will help, but I like this better because I can see what's coming. So if you, So if you look at this, and this is typical of many of the pension accounts that we manage, by the time you start saving, once you get to long term, say anything from 10 years, you'll find that when you have your total assets, the bulk of the value in there is the growth that comes from investing. It's not the money you put away. So this is the difference between savings and investments, right? The gray chart is the money you actually saved. So if you were just putting money away and it's not yielding anything, by year 30, that gray bar is where you'll be. But the growth on the assets, and this is just looking at sort of a typical annual return of 20%. 20% is high in anywhere in the world, but in Nigeria, that's actually not that high. We're in a high inflation environment, so we're also in a high return environment. So by not taking that much risk, you can make 20% per year on average, not every year, not guaranteed, but on average over the long term, you can easily make 20% per year. And if you look at that, 20% per year on a savings of 50K per month will give you over 600 million in 30 years. Believe it or not, that's just math. Just saving 50,000 naira a month for 30 years, which is not far-fetched. I mean, 30 years can seem like a long time. It's not really a long time, So of course, not everybody has 50K every single month. If you're talking to a typical 25-year-old and say, just start saving now, 30 years, you'll be 55, you'll be retiring. You might not be able to start with 50K per month, but you start with something and you're getting there. And the real purchasing power of this money, that's the other thing, because 600 million sounds like a really big number. But maybe 600 million in 30 years will have the purchasing power of whatever, 100 million naira per year today, in today's money. It's still material. And putting that 50K away for many people is not really going to alter your lifestyle today. So it's not like when I do 50K per month, this is the difference between me being able to go for summer and me not being able to go for summer. It actually doesn't change much your lifestyle for most people that are in the middle of their career. So, just to see the power of numbers, and that really comes from the compounding and the growth, not from putting it away. From that 600 million I said you'll have at the end of 30 years, less than 200 is actually what was saved. A significant proportion of it is from the accumulated returns over time, assuming you're not withdrawing. The second chart I want to show, and this is quite instructive as well, this gray bars and the gray curve and the red lines and the red curve, they represent two different investors. The investor one is someone that saved consistently per month for 10 years and then stopped saving. Like, just left the money there, stopped saving. And then investor two is someone who started 10 years later. So this is just to illustrate the value of starting early. The person who started in year 11 and did it for 30 years versus the person who started in year 0 and did it for 10 years, they end up in exactly the same spot by year 40. So this assumes you're contributing the same amount of money per month and you are earning the same average return. The return here, I ran these numbers by myself. This is not theory. I did this chart. I did it when I was working at Alan Gray. So you can see Alan Gray colors there. It's a very old chart, but it's real. And I did it in South Africa. That's why you're seeing this R rand there rather than Naira. But the story is really the same. Remove the R, put in, this assumes a 4% return on investment, which is what is typical in a place like South Africa. The point we want to make is starting early. Investment return is all about time value and compounding. It's all about time value. So money you put together for 10 years and invested for the remaining 30 years, or 40 years rather, it's just the same ending value you're going to have because you started 10 years late. You're going to contribute for 30 years to catch up with the person who contributed for 10 years but started a long time ago. So if you don't take anything away tonight, take these two things away. That number one, consistency is paramount. And number two, it's just like planting trees. The best time to plant a tree was 20 years ago. The second best time, if you didn't do it then, is today. And then I don't know, I'm Muslim, I'll bring you one Muslim data point. We're all kind of learning about each other. In Islam, they teach us that the acts that are most beloved to God are the ones that are consistent, even when they're small. So the person who is giving 10 naira in charity every day is more beloved. That's what our own religion teaches us, than the guy who shows up every 5 years or every random when he wins the lottery and drops 5 million and disappears, and we don't see him again until the next time. Small acts that are consistent are really quite beloved, and you can bring that principle to investing as well. It's not really about how much you do, but you must be doing something consistently. So what's the challenge? I'm assuming many of us here are Nigerians in Nigeria, but even if you're not in Nigeria, the story is starting to look the same, right? I remember when sometime in the UK, I just remember this so vividly, some Oyinbo making a presentation and telling us that, the Western world has conquered inflation. And that thing is in my head till tomorrow. It said it in such an arrogant, boastful way that we have conquered inflation. And we've all come to find out that that's not true at all. I mean, the kind of inflation numbers you're now seeing in the US, in the UK, everywhere in the world, now inflation is a global problem. We had our own problems before, it's magnified, but even all the people who felt that we've conquered inflation, they've come to find out that, that's not correct. The biggest driver behind all this conversation we're talking about is the fact that inflation is eating at the value of your assets, your purchasing power, the value of your savings. So you have to run to stand still. And many of us here are not looking to stand still. We're trying to actually move forward, not just stand still. So in Nigeria, average inflation over the last 20 years has been anywhere from 12 to 14% cumulative average over time. Of course, we know today inflation is above 20%. But when you average it out, we get 12 to 14% per year over a very long period of time. What does that mean? If you look at this chart here, what 100 naira was doing in December 2005, you need 500 naira to do it in August 2020. And we know that we're now in 2023, so you can chart this line and curve it up even more. And it is that inflation and that devaluation of the naira that you're seeing in the exchange rate. So the November 2005 dollar rates at, just over 100, if many of you remember then, it was 98 naira. At the end of this chart, it's like 350. And we're talking officially, right? We also know that even this official rate of 400 and something is not accessible. We're talking more 700 today. So whatever you're doing, and many of us are global citizens. Yes, we're here in Nigeria. We want our schools to, our children to go to schools in the US. We want to, maybe access international medical care and all that. So the hurdle you have to surpass is you must make sure that your purchasing power is preserved in global terms. So 20% per annum, I use it as a benchmark, but it may not be enough. So as you are investing, you're thinking, what is a way to ensure that I'm finding an inflation link? So whatever is surpassing inflation, typically over time, preserve your purchasing power, even if you look at it in dollar terms, because the movement in the exchange rate is basically just tracking what is happening with inflation. So let me do this. Hopefully it will be better. So what do you do? What are the mistakes that you don't want to make, or, what do you make sure you're doing? So I said it, don't leave money idle in the bank. Don't put all your eggs in one basket. Have a money plan. You're saving, but you're also investing, and then you have the spending plan. I think one other misconception people have is that it's just because my salary is not that high, or I'm not yet earning the amount I need to earn to do what I want to do. But it's not really about how much you're earning. The issue is how much you're spending relative to what you have. So if you continue to think about it from an income target, so you'll find people, and all of us here know this, right? You have friends that earn less than you, or family, their salary is not up to yours, but they're able to acquire all these things you cannot. All else being equal, we hope they're doing honest things, right? It's just spending pattern. So some people you'll find at a lower income level still have higher savings. And there's some people at a higher income level that cannot save or invest as much. So the issue is not how much is my salary, how much do I have? It's just the issue is what is your spending relative to your income. And if you have a hard cap, I'm never going to spend more than 60 or 70 or 80 or 90%, whatever number works for you of my income, then it's not going to matter what your income is. You just maintain that discipline. As your income grows, then your savings and investments will grow, and you make sure that you keep your spending under a tight lead. How many of us have thought that when you get a salary increase, you'll just save all the incremental? You find out within 2 or 3 months, your spending has cut off and surpassed whatever. So it's really a spending issue. And you must have that honest kind of come to Jesus conversation with yourself, that this thing is about your spending and your discipline. It's not about your income. Drivers save, nannies save, house helps save, cleaners save and invest. There's the magnitude that's different. So whatever it is you're doing, you can do the same. I think also greed is your enemy. If you look at someone like a Warren Buffett in the investment world, you'll find out that if you go and look, if you're someone that is a data geek, like just go and check maybe over the last 30 years, was Warren Buffett ever the best performing investor in any one single year? You'll find out that never. He's never number one in any year. But if you measure 10 years, measure 5 years, measure 20 years, he'll be number one. And that strategy is a strategy where I don't take risk, I'm not greedy, I'm not trying to do anything I don't understand. He never gets wiped out. So a lot of people in their saving and investing, the difference between the people who end up with a lot of accumulated value and people who don't is how much you lost along the way. It's not really about how high your money is growing fast and all that. You want to make sure that you are not having significant losses or material losses, because losses are very difficult to recover from. So even if all you're doing is plus 10, plus 10, plus 10% every year, you'll be better off than the person who does plus 20, minus 10, plus 15, minus 30, plus 2, that's not good. And a lot of that is driven by greed in investing. So kind of looking for that, how can I quickly double my money? How can I quickly double my money? You want to think that this is a long-term journey. I have never made any investment that doubled. And I think that one of the reasons why I've been very successful in my career in investing is because honestly, I don't have any greed. I'm not one of those people that is trying to. So when I come home, sometimes I'll share investment ideas with my husband. Like I'll make an investment. I'll tell my husband, I'm doing this in case you're interested. I'll make money. My husband will lose money. Always the same idea. Why? Because we'll do something together. Once this thing is up like 40% or something, I'm already thinking, okay, how do I liquidate? Let me take my money out. My husband will say, I made 40%. Let me go and add more. At the time when you should be thinking, okay, I've made money, let me, crystallize it, let me keep it safe. You now double down, triple down, then the whole thing will crash and fall apart. So you really want to make sure that you're not thinking with greed or investing with greed. And I feel like greed is something that is so pervasive in our environment. I don't know why, maybe culturally. So there's all these Ponzi schemes. They're everywhere. Even last month in my house, one of my kids' lesson teachers came to the house and was advertising what was obviously a Ponzi scheme to my 2 nannies. Was telling them that when you put 10K, you get this. And I just heard. And I told them, don't, anyway, I've advised you what is enough for the wise. But they all did it. They all put 10,000, the driver, the nanny, the house girl, all of them in my house put 10,000 in this crazy scheme last month. They've all lost their money. And I told them, so, and they're not rich. Couldn't even imagine that people on that income scale are losing, 10,000 in a Ponzi scheme after being advised. So sometimes we're our own sort of enemies, right? But we get to the point of, we talked about the do's. I said, have a plan, implement it, don't leave money idle, don't follow the herd, don't be greedy, and diversify, seriously. So a lot of times people always come and ask me, do you think this is a good investment? Do you think, should I do this, should I do that? And I always say, there's no such thing as a bad investment. So long as you're not talking gambling or Ponzi and all that, there's nothing that's really a bad investment, right? The issue is, how exposed are you to it? How do you quantify, okay, how much do I have, what percent? So if, should I do Bitcoin, for instance? If you carry all of your money, or your children's school fees, everything, go and buy Bitcoin, that's a problem. If you have 100K to invest and you take 5K and put in Bitcoin, that's a different story. So a lot of times, good or bad is around how you quantify your own risk capital, your exposure, and how you diversify. that, okay, let me just try this Bitcoin thing that people are saying, I'll put 2K. If I lose it, it's not going to kill me. It's not going to, hurt my ability to kind of meet my long-term goal. Then it's a good thing. If you're going to mortgage your future and your children's future on the speculating, then that's a problem. So diversify, understand what you're doing. Don't put all your eggs in one basket. When I talk about Ajo, I always tell all these women that say it's hard to save, everybody's doing Ajo, everybody's doing a susu, but they claim that they can't invest or they can't save. What's wrong with Ajo and Isusu? Absolutely nothing. The problem with it is that it's only good for you if you are packing first or second or third. Whoever is packing last is the mumu. So if that's all there is to it, because at the end of the day, what is Ajo? What is a susu? It's a bunch of people lending. It's just group lending. So the person who picks first is getting an interest-free loan. The person who picks last is writing an interest-free loan. So what's wrong with a loan? Banks do it. Everybody, we all lend our money. It's that investing at the heart of it is taking risk and being compensated for that risk. So even in Ajo, yes, it's a group of friends, we all know each other and all that, you're still taking risk. The risk may not be credit risk in the sense of maybe one of our members will not pay, no. So there are different types of risk. Time value of money is a risk. I give you 50K in January, I pack the 50K in December. Meanwhile, January, 1 cylinder of gas was 30K. December, cylinder of gas is 48,000. So risk is not just about what if I don't get my money back. There is credit, there's time value of money, there is liquidity risk, there is, I can tell you risk 101 lessons, right? There's a risk that you've promised to do this Ajo, something great comes up in the middle, you don't have the capacity to do it because you're already committed to this Ajo that is giving you nothing, right? So if you can put your money in Ajo for 12 months, put your money in something that is yielding something instead. And if a group of women want to come together to do Ajo, somebody in that group should know enough math to be able to compute the time value of money such that the person who picks in January is not going to receive the same amount of money as the person who picks in December. A whole year has passed, and there is an interest component that should be computed. So if you are doing Ajo and you are fond of picking early, I would say you're smart, you know what you're doing, carry on, so long as you can find the people that are willing to continue subsidizing you. But if you are doing Ajo and you're always packing last because you feel that this is what enforces your savings discipline, then it's a poor choice of vehicle to do that. You can put your money away for 12 months in a way that yields you something, not for free. So that is my grudge with Ajo. I'm not reading the comments, but I can see, messages coming in, so I'm sure we'll get to it. Don't be nice to a fault. We all know that there is no social safety net in Nigeria. Many of us here, if you compute how much you dash people compared to how much you save, you will know that on a monthly basis, you're doing more charity than investing. So if you start from there, and this is not don't help, it is have discipline around everything you're doing. Decide how much your giving budget is for the month, set it aside, give out of it. Once it is done, for that month, it is done. If anybody comes to ask you for anything, say next month. You're a salary earner, all of them, they know that it's 30 days, make one pay. So unless you're a politician's wife, which I guess is different, but for many of us that, do 30 days, make one pay, just decide how much maximum you're going to give in a month, maximum you're going to invest in a month, and stick to it religiously, because Nigeria will finish you. Problem, no, they finish. I mean, I'm talking genuine problems. I'm not talking about people trying to take advantage of you. I'm talking people in genuine difficulty that will come to you, and it will be so difficult to say no. But you have to understand that it is also self-care to ensure that you are not destitute in future, and that your own children too. And it is irresponsible if your future is not assured and you are helping somebody's present. It's irresponsible. I'm not saying don't be nice, but that's just all there is to it. So that thing, it's such a danger. And if you can open a separate bank account for it, open it, because many of us here, if I ask you, January to date, how much have you given out in charity? Most people cannot even give you the number. You don't even know. So, because it's just 2K, 2K, 5K, 10K, 2K, it's just everywhere, family, friends, church. So even if just for the sole purpose of measuring this thing, open a separate account, fund it with your charity budget every month, and do all the giving from there. And then audit it after 6 months or 12 months, and then decide what you want to do. Some of us may be in a situation where you realize that I even have capacity to increase it. That's great. Some of you will be in a position where you think, you know what, this is a lot. I need to put some control over it. And then that's great as well. The other point I want to make is real estate. Nigeria, real estate, 5 and 6. Our people love real estate, buy house, buy land, buy house, buy land. Nothing wrong with real estate, but it's very illiquid. It's also a very inefficient vehicle to sort of be the base of your savings. You will get to a point where, you want to make sure you have liquid assets. Let's put it that way. You also want to make sure you have savings where you can tell kind of what the value of it is, and that you can quickly realize that value if you need to. The problem with real estate, people will just tell you that houses in Ikoyi are 100 million. Or, you see a lot of list prices, in Nigeria particularly, you don't actually see a lot of transaction prices. So if you go online, Google how much are they selling house in Ikate, you see all sorts. But nobody comes to, that's just what one broker put on the website or one agent. You don't actually know what the true value is, and the true value is where the transactions are. So I'll give you an example when I get to real estate in front, but I know that I sold one property in Elegushi last year. We sold a 4-bedroom terrace house for 70 million naira. To you guys, does that sound cheap or expensive? It's like, oh, they bad you, they cheated you, or whatever it is. But because if you go online, you'll be seeing 150, 100, 121, you'll be seeing all sorts of prices. But when the time came to really sell, all the offers, all the bids we got were 70, 72, 60, 71. So you'll find that the real transaction prices sometimes are very different from the asking prices, and that it's difficult for you to realize the value because you are carrying paper value. So you don't truly know what you are worth. You just know that I have a house in Ikate. They claim that, they say it's 200 million. You actually don't know. It's only on the day you try to sell it that you know whether you have 200 million or not. So real estate can be inefficient in that way. The other thing with real estate is that rental yields in Nigeria, they're quite low. So if you are buying real estate, because you want to live there so that you can avoid paying rent and therefore save money and all that, that makes sense. If you're owning real estate just to rent out and rent out and rent out, you will find that the good ones are expensive, the bad ones are bad. Like, that's the summary, right? So if you buy high-end real estate, the rents actually don't justify the prices for those, for those assets. So you're almost better off just buying a treasury bill sometimes, because you buy a house in Ikoyi, for example, 350 million naira for a simple 4-bedroom bungalow, 4-bedroom. How much is the rent? 10 million naira max per annum. So that's like 3% on the value of the house. So it's not enough at all in terms of the income that you should generate. When you go and buy cheap property, low-end property, then actually the rental yields are higher, but you don't want the trouble of going to rent in a low-income area, you understand, because then, so it's all about risk, because then your issue of defaulting on rent is higher, your maintenance cost is higher, the quality of the environment is lower and all that. So the point I'm making is that if you go and buy a property of 25 million in Ojota, you still get 800K in rent. So if you compute that, my annual income divided by how much I spent, you'll find that the Ojota investment is actually better than the Ikoyi investment. And sometimes people tell you something about capital appreciation. We can get into that later when we discuss. But the truth of the matter is, if you're already buying a house in Ikoyi for 350 million, where is it appreciating to? Just think about it, So, but people just say real estate always appreciates, real estate always appreciates. It's not true. Real estate doesn't always appreciate. And even when they do appreciate, they don't necessarily appreciate at the same pace. You will get way more capital appreciation from a 20 million naira property in Ojota than your 350 million naira property in Ikoyi. And that's the T, I'm telling you. But do you want to go and buy a house in Ojota? You don't know what's going to happen there. You don't know the kind of profile of the tenants that will come. You don't know when they're going to owe you money. You don't know when government will decide, what this about Ojota is too rough and we want, So everything comes with its own risk. You cannot make the foundation of all your investments real estate. That's the long and short of what I'm trying to say. The other thing about real estate is that there is this obsession about owning homes in Africa. We need to have our own home. We need to have our own home. And you want to be thoughtful about that. So you find the young people. I know this guy who, he started coming up in life. He made some money. He and his wife, they built their house in Shasha. Very nice house. Built a very nice, not a mansion or anything, just nice in Shasha, because he just felt that we've arrived at this point. So they lived in Shasha 4 years or so, and they realized that God has even blessed us more than we're no longer Shasha people. So they left the house in Shasha, went and built in Yaba. Very nice house on Abamakali, really nice location, all that. It's a nice house in Yaba, they moved there. 5 years later, they've hammered even more. They moved to Oniru. Now, who's going to go and buy a really nice house in Shasha? They've been trying to sell that house. It's over 10 years. They can't find a buyer. The one in Yaba, they're trying to sell it. Yaba is coming up now, so they might have some luck with that, but they won't sell it for how much they built, because they were building these houses for themselves. It's very nice. It has marble. But the people buying homes, they don't care. Shasha is Shasha. It's all about location. They don't care if you put marble or you didn't put marble. So they will sell it, but most times they cannot recoup the capital they put in. He's left Oniru now. They have this beautiful house in Lekki. This person is actually a relative of mine. That we call it Leckingham Palace, where they live. It's so beautiful, great house in Lekki. But what's the lesson here? Is that you've gone to kind of commit yourself into something that is really long-term capital and ties down a lot of your capital because of your understanding of what your life is today. But you don't know what God has in store for you tomorrow or next tomorrow. It's like, I feel like they just rushed into owning their homes very early in their marriage, and now they're left with a string of homes that they've outgrown, but they cannot monetize. So it's wasteful. There's nothing wrong with renting up until the point where you can make a long-term commitment. People are always in a hurry just to know that we're our own landlords. The number of people that have built houses in Mowe, Ibafo, Ikorodu, and cannot live there today. Because even if they've not really hammered and outgrown those places, they've just found out that they cannot cope. So you've built your house in Mowe, you're working in VI, you've lived there for 1 year, you've realized that either I will die or this house will kill me. So you now come back and go and rent a place in Yaba, but your house in Mowe is there. Even if you rent out your house in Mowe, you can't pay the Yaba rent. There's just some poor decision making. I see that a lot. And a lot of it comes from emotional decision making. I just want to know that I'm a landlord, or all my friends own their own homes, I want to own my own. And that capital, if you had invested it in something more productive, more this, more that, and it's been working for you, you might be able to, rather than abandon the house in Mowe to come and rent in Yaba, you might have gotten your finances to a place where you could actually come and buy Yaba by delaying that home Mowe thing for 10 years, right? So it's in that decision making, like, don't be driven by emotions, don't be driven by fear or greed, don't be in a hurry. Make sure your money is working for you. What you want to use that money to do, don't be in a hurry to, kind of get there, I think. And then again, I mentioned this greed thing, but sometimes when you want people against greed too much, then they start kind of being driven by fear. In investments, it's a seesaw. It's fear and greed, and you want a healthy balance. You don't want to be so fearful that all you do is kind of hide your money under your mattress. You also don't want to be so greedy that kind of all you do is like gambling and stuff. So healthy balance where you're taking risk, but it's informed risk, is educated, is calculated, and that you're getting rewarded for the risk that you're taking. And then, I mean, for many of you here, we don't need to say this, but I think for older people that we tend to talk to, people that are close to retirement, so please don't rely on your children as part of your retirement plan. The world is getting a bit more difficult in general. I think we definitely had a tougher time than our parents, our children. Touch wood, we hope the country gets better, but the world has changed. You know, the children don't have it as easy as parents, and they're trying to build a life for themselves. So you need to figure out what you will be doing for you rather than hoping that I give my children all these Harvard MBAs so they're the ones that take care of me. Most times they're just worried about themselves, and it's not coming from not being good children. It's just the world is a different place. Our parents, you know, when they left UI, they all got a car when they worked for the government, right? That's just 10 or 20 years ago, whatever. I mean, the story has changed, and it is what it is. So this is a wrap up. You want to be disciplined and religious. You want to make sure that you have a liquid emergency fund. You want to make sure you are saving in inflation protected assets. As much as it pains me to say this, I tell all our people, please get as much USD exposure as you can get. For it may not be USD, maybe Canadian dollars, maybe GBP, whatever, but more long-term stable currencies. The Naira has been so unstable. And as patriotic as we are, as much as we love our country, we also have to take care of ourselves. Part of taking care of yourself is to make sure that if Nigeria decides not to have too much sense, you know, that you are, you know, in a place where you're a little bit insulated from that. That doesn't mean you should hide all your assets abroad. Even in Nigeria, there are a lot of things that can give you kind of US dollar link. You want to be thoughtful about depreciating assets. Even a house can be a depreciating asset. Things like cars, things like phones, we all do it. We all do it, you know, but you just want to be very thoughtful about how much should I spend on a car? How much should I spend on a new phone? When Apple is bringing 13, 14, 15 every September, must I really be, you know, a part of that crew? You want to educate yourself with a lot of things. I found that a lot of women now, they'll do their makeup and you will be asking, who was your makeup artist? They'll say, I did it by myself, you know? So this is something that a lot of things that you are interested in or you care about, you really do go out of your way to learn how to do those things. And investing shouldn't be that different. So you just have to dedicate the time to know some of these things and know how to do it by yourself. Financial advisors are great, but if you're not kind of trying to do it on an industrial scale, you're not a billionaire trying to, you know, you're just trying to do you, a lot of these things you can do by yourself. And it takes effort, you know, and the kind of effort I'm talking about is not by a textbook or whatever it is. This is something we're doing here. It takes time to, the many things you can be doing, but you join this call for 1 hour, you get something. You go somewhere else, get something, you know, make sure that you're in that learning mode, you're talking to people and, you know, I said be thoughtful about life's milestones. That's what I was talking about earlier, about things like when should you build your first house? When should you, you know, there are a lot of people that don't have homes, they don't have their own house. But when they're ready, they'll just get up and go and buy it. They you know, the fact that he doesn't have his house doesn't mean doesn't have any, you know, they've been saving, they've been investing, they have a lot of assets, and when they're ready to go and buy a house. But many of us will scream, go and build a house, but you know, you're so illiquid and all that. And then factor in opportunity costs and implicit costs, you know, for all decisions you take. I always talk to people about writing wills. It's very important. It's not common in our environment. You know, death is not our portion, but you know, we all buy insurance for our cars. I mean, accident is not our portion too. Write a will. It's very important. And encourage your spouses to do the thing, because sometimes we see some financial devastation that comes from just poor estate planning. You know, people have assets, somebody doesn't know where it is, or it's not properly titled to transfer and things like that. So make sure you're doing that. And then I say train your children. I say it jokingly, but it's important because you can do all of this work, and irresponsible children can turn it all to dust very quickly, either in front of your life or behind your life. I mean, I've seen in pension industry, we see all sorts. We've seen children like fake their parents' death and come and take their parents' pension assets without the parents' knowledge. So they'll just come and, they'll come with obituary. I've seen this not just right, bring obituary, bring fancy will documents, this, and say they want to collect their parents' entitlement, and they'll collect it and go. Then next thing, the retiree will show up 4-5 years later and will be like, wait a minute, what happened? That happens. So again, having responsible children that will not put your work at risk, but will also not mismanage, whatever is left behind for them, I think critically important. So what are some of the investment ideas that we have here? I've talked about practical steps. I'll skip some of these things because you know what they are. The 2 or 3 critical things I'll say is that write things down, like don't use a mental plan. Have a separate bank account. I've talked about it. Do a separate bank account for gifting. Do a separate bank account for your investments. Don't mingle everything together. Be deliberate, because that way there's a sense of purpose that you're bringing to it. Understand how much risk you are able and willing to take. Willingness to take risk is something, ability to take risk is something else. So how willing are you to take risk? How much can you take? How able are you? And then make sure that the investment options that you are selecting best align with your goals, your risk appetite, where you are in life, what's the age of your children, and things like that. Like, what sort of bills are coming ahead of you. And there's blessing in, every situation in life. I think, when I got married, my husband and I, we didn't have kids for like the first 6 years. And it was a very stressful period of time, but it really allowed us to do a lot of things that our peers couldn't do. Just because, many people that were in our position, like school fees was just sucking their money. We didn't have to do that. And so we could do other things. Now, many of our friends are now in the stage where their children are grown or growing and they have a bit more respite. They're now thinking, what can we do? So again, look at where you are in your life and think about what can come first, what can wait, what priority should be. We, in a life challenge we had, we were able to see that in a way, it was a bit of a blessing from a financial planning standpoint, because we just didn't have so much bills. And so we could do a lot. Now the bills are here and the children are here too, so you're able to prepare. So there's not one plan that fits all. I think your unique situation should inform of what you're prioritizing over what. And when you always look at opportunity costs, when you kind of make decisions and think about what the risk is, what the risk is not. I've been in position to advise a lot of people now, this whole Jackpot thing. So at my job, we have that, like, so many people going to the UK with student visa. And it's so expensive, So I just talk to people around, think about how much you're spending, think about what you're getting, in return. So that eventually boils down to things like, what course are you going for? Because everybody's just like student visa UK. And behind all of that is the hope that you'll get this 2-year post-study work visa and maybe ultimately get a job. So you want to maybe think about, what are you studying? What are the odds you're going to get a job? What are the odds that, so again, is that risk reward mindset, if you bring it to everything you do. So that answer is not the same for someone who is going to sort of a highly rated university to study a highly sought after course, compared to someone who's just going to University of ABC in the UK to study XYZ. So if you bring that level and understand that at the end, behind all of that, it's an investment decision. Investment is not just about buying stocks and bonds and assets. whatever you're putting a large amount of money towards, it's an investment at the end of the day. Then you want to make sure that the payoff on that investment properly compensates you, for the risk and the uncertainty that you are pursuing. So I said this, make sure that it's a separate bank account. Make sure that if you don't know anything about this thing, use professional help, get an advisor, open an asset management account. There are many reputable places where you can do that. ARM is one, Stanbic, Chapel Hill, it's all the reputable names. Many of the big banks now have asset management businesses as well. You can start from there and then gradually build your expertise to do it yourself, because what professionals cost you is fees. So if ARM was to do it for you, we'll charge you a fee every year. Stanbic will charge you a fee. If you're a billionaire, you're happy to pay that fee. If you're really trying to build, a war chest for yourself, maybe you don't want to pay those fees, but you got to invest the time to learn how to do it by yourself. And if you're doing things like real estate, like writing a will, like doing private investments in private companies, for instance, your friend's business, they'll say, come and invest. I've heard that a lot. Make sure you have a lawyer. Make sure you have your own lawyer. Lawyer up. Like, don't skimp on your physical health. The way we take it so seriously, you got to take your financial health just as seriously. You buy a piece of land, it's not titled properly by a good lawyer, well documented, could run into trouble. So don't be afraid to use professionals. And some of these guys are not that expensive. And even when they are, it's an investment at the end of the day as well in doing things properly. So you may be familiar with simple investment structures. I'll talk about a few of them, but I'll let the Q&A really lead how I go into investment products and investment ideas. We know basic things. All these things I write here, these are the things that are most simple and most common. It's just a place to start, because many of these, they'll grow your assets, but they won't protect you from inflation. The best they probably would do is just keep up. But if you're somebody that is, all you're doing right now is Ajo, like, it's still a big step for you to move from Ajo to move to this, because this will largely keep up with inflation. It will not exceed inflation. And what you want to be doing is exceeding inflation so that you are increasing, your purchasing power. So if you're doing government treasury bills, commercial paper, mutual funds, like the fixed income mutual funds, savings bonds, fixed deposits, all of those things will at least grow your funds, so that if I save 100K this month, I'm not going to come and meet 100K in December. I'll meet 110. So this is not what's going to get you, wealthy or rich, but it's going to make sure that you're not stagnant. When you think about equity investing, and this slide, I've had them for a very long time. As time passes, people don't even want to talk about public equities at all. But at the end of the day, equity will always do better than fixed income. Equity requires more thought, more process, more discipline, but there's still money to be made. What do you find with Nigerian market? Because we don't have that much discipline in the market. When I talk about discipline, I'm talking about from an investor standpoint, from a corporate governance standpoint, from a market efficiency standpoint. There's a lot lacking in the market. So it's not the kind of market like in the US where you just buy Walmart shares and just go to sleep for 50 years. Unfortunately, you can't do that in Nigeria, right? So I would say that it's a trading market. It's not a buy and hold and just keep your money for 20 years market. You've got to trade, you've got to be in and out. But if you're doing that and you're paying attention, you can make a lot of money. Like this year, I don't know if any of you have been singing Femi Otedola and Tony Lumelu doing Basbos with Transcorp, but in the middle of all of that, the stock is up almost 400%. This year alone, we're just in April. So things like that will always come and go. The banks still pay. Access Bank paid 17% dividend yield, right? So if you bought Access Bank shares, even if the share didn't go up 1 kobo, you made 17% from dividend. That's something that's really high. In a market where inflation is 20%, getting 17% return in 1 year is at least keeping you within kind of touching distance. And in equities, as you know, beyond the dividend, you could get some capital appreciation. So we've seen a lot in, I'll give you an example. Like if you buy Airtel shares, for instance, Airtel, the mobile phone network, they give you the option to receive your dividend in dollars. I don't know if you guys are aware of that, right? So you could buy the shares in Naira and pay its dividend in dollars, and you just be accumulating it gradually like that. So there are many little gems like that, little gems in this market that if you are paying attention, there's money to be made. Again, it's all about how you size it. What percent of your savings are you putting in something safe and secure, like a bond? What percent are you using to trade the equity market to give you that little, extra? And like I said in the first slide, if you aim to just 20% return every year, that's not too difficult to do and it's not aggressive. If you do it over a long time, it's very material. So these are examples of things you can do for 20%. I think in terms of private businesses, I see a lot of people investing in private businesses, either for themselves or my friend has a business, she said I should come and invest in her business and all that. One of the things I will say is, first thing, if it's an established business, you need to study it well, all that stuff. If it is a startup, globally, only 1 in 3 startup businesses survive 10 years. Only 1 in 3 start a new business from scratch. Only 1 in 3, like majority fail, majority. And in Nigeria, obviously, the data will be worse because we have bigger issues. So if somebody brings a business idea to you, you need to be looking at it with a huge skepticism, right? Your skeptical hat is what you should be wearing. Like, with all goodwill, this guy is smart, he's great, like, I like him, he's not fraudulent, blah, blah, blah. The chances that they will fail is already very high. And that doesn't mean you shouldn't do it, but that should inform the kind of questions you ask and the maybe amount of exposure you want to have to that kind of venture. So start from there. Then next, you want to make sure that your goals are aligned. Do you understand the business? The surest way to create wealth is to be solving a problem. If you are evaluating any business, either you want to start the business by yourself or somebody starting on, put your money, think about what problem are we solving. And most times, if there's a real kind of gap there, then they're onto something. It should be viable on paper. There are a lot of entrepreneurs that will pitch a business to you and it makes sense, but you ask them to write it down, they can't. Don't put your money in anything that doesn't have a well-written business plan, basic assumptions, basic forecasts, basic risks. Have they been identified and documented, things like that? And then calculate your downside. Can you live with it? So if I lose 50% of this money, will I be okay? Is it going to bankrupt me? And then if the terms don't work, just walk away. Like I said, don't be greedy. Don't feel like I must do everything, that comes around. One private investment that we thought about very recently is there's a preschool. My children go to a preschool here in Ikoyi, and the owner was looking to sell. And I really, really wanted to buy that business because it's a very good business. One of the things I know for sure that I'm not a teacher, I have my job, I don't ever plan to become a teacher and all that. And the only way it made sense to buy the business was for the people running it to continue running it. So the background story, just to help you see how I think about investment and how we think about investment. The school is owned by a company, by a consumer goods company. The company just decided, they made this school just a preschool. They don't have primary, it's just 0 to 5. In fact, 2 to 5, And they were in a building they were renting for 15 million per annum. They've been in that building like 9 years. The owner of the building then said she wants to use her building, they should move out. So they started looking for new locations, and the cheapest rent they were seeing was now 25 million. From paying 15 million rent before, the rent was about to go to 25 million. So the preschool, how do you accommodate that increase in rent? You can't just double school fees, which is essentially what you would have to do to keep up with rent that's going up, almost 70%. So the company just said, this school is too much. We're not doing school anymore. Meanwhile, the school is really great. There are a lot of kids. The staff are great. We that are parents, my children are there. That's how I heard about this thing. Those of us there, when we heard the school wanted to shut down, we're almost crying. Like, it's a great product. So I felt that this is a business that I can pull some friends together and let's just buy it and run it, because all we need is just the extra money to pay the new higher rent. And you might cover it from increasing school fees a little bit, but also from just growing enrollment. So long term, it's a viable business. It's just the company felt that we're not here to run a school, we're a consumer business. We were just doing it maybe to encourage our staff, and now we feel like it's not necessary anymore. So what's the critical thing? As much as I saw that it was a very valuable business, they shared the numbers, I looked at the accounts and all, I spoke with the teachers there and I said, for it to make sense, all of you, because at the end of the day, it's an existing product. All the kids are there. When we say we like the school, you like the teachers you're seeing, you like the environment, you like. So if we buy the business in a hurry like that, it's really just based on the assumption that you'll be able to retain the bulk of the students and bulk of the staff, and then you can now grow it over time. But all of a sudden, all the staff were just saying, well, the expert staff, the foreign staff, they were just saying, no, I don't want to stay, I don't want to stay. And I heard that it was because, the company is a foreign company, so they employ a lot of foreign staff. So I heard from the grapevine, and I don't know if this is true or whatever, but that the foreigners were saying that they don't want to work for a Nigerian. So they were happy to sell and take over and all, but many of the foreign staff were saying, oh, we don't want to stay on when the new owners come on board. So for us, the club of individuals that wanted to invest, that was a deal breaker, because you understand that this is an existing business and it's existing and generating XYZ because of certain things. The people that work there, the brand, the quality, and all that. So I can buy it and just look at how much school fees are they paying per year, how many children, multiply it, start kind of building dollar signs in my head. But the two critical things is no longer the same product. So you cannot assume that if you buy it and all the people that work there leave and you just bring new people to replace them, that the economics will be the same. You don't know that you will be able to replicate the quality. You also don't necessarily know what you are buying, because you can't say what percent of the students will choose to stay knowing that all the familiar faces are gone. So the investment on paper and the reality of the investment, they are really two different things, because on paper, all you will be looking at is how much do you charge in school fees per child, how many children are here, let me assume how many children I'll have. But in the real sense of the word, you've got to kind of understand where the paper meets real life and be able to be dispassionate about moving those things around. So even when, let's say I found someone that said, well, I'll run it for you, like let your impulse go out, I can do it. I'm like, if all else fails, if this person walks away and these people walk away, am I ready to leave my job and go and face this thing, right? And if you cannot say yes, then it's kind of too much of a gamble. So it's a big example, but you can distill that down at any level, right? If you do a joint venture with a friend, if something happens to that friend, can you carry on? Can you run it? Can you do it by yourself? If you guys fall apart, can you easily pull it apart without kind of destroying things? And does everybody have skin in the game? What do they have at stake? So a lot of times you find people telling you to come and fund their business idea. They don't have capital, but they've got great execution, great idea, great all of that, and they'll do it with your own capital. What that does is that it just makes founders' commitment very difficult. Because if you fight, they'll just up and go, or if things aren't working out, they can move on to the next thing. What do they have at stake? How much of their own time and commitment is into this thing? Because I find that a lot, and the reason why I'm spending time here is that I find that a lot of investments people make are in private businesses, either of their own or of friends or of spouses. And these are really the risks and challenges. You've got to follow your money as well. You keep your eye on your money, keep your mind on your money. Whether you are actually investing equity in this business or debt, you They send you accounts every month. You ask for audit if you want them, and don't invest money you can't afford to lose, even if it is in your own venture. That boils down to risk sizing that I said earlier, that at the end of the day, what we call investing is nothing but taking risk, quantifying risk, sizing risk, and making sure that you're getting appropriately compensated for the type of risk that you are taking. I want to give example of two, three basic investments to complex investments. This is a very basic one that I did for someone literally yesterday. You can see it's 28th of April, is a real life example. The woman that has this money, she's retired. This money, she's been keeping it since I've been buying commercial paper for this woman. It's my mother's friend. She's an old woman. And this is kind of the bulk of her savings. And we don't buy commercial paper. So this commercial paper, she has 23 million in face value. So the money, we placed it yesterday, 28th, it will mature 19th December. So to buy this, she paid 20.9 million to buy 23 million face value, right? So essentially you're just getting interest up front. That's what it is. So she'll collect 2 million, roughly 2 million in interest, which has already been paid to her yesterday, but the 23 million is secure and she'll get it back on 19th of December. So she just pays herself a salary from this upfront interest. She lives in Ibadan. She retired like over 10 years ago. She's an old woman. She would just tell me that, Abimbo, I'll just be taking 200,000 naira per month as my budget. I'll pay it to myself as a salary from this upfront and know that the bulk of my money is safe. So this is like the most simple, basic, it's low risk, it's liquid. The company issuing the commercial paper is Dufil Prima. Dufil Prima makes Indomie. So it's not some risky business. If you want a higher rate of return, some are available. Of course, there won't be businesses that are kind of blue chip like this one, but if you want to buy a 20% commercial paper, and if you could mute yourself, please. Yeah. So basically, you can do things as simple as this. These kind of things are a better alternative than doing a susu, right? It's simple, and you don't have to do 235 days. You might find a product for 90 days, 180 days, 235 days is 7 months. It's not that long. So you can lock the money away and collect the interest upfront. You can keep the interest and roll it in, right? So instead of buying a discounted value of 20.9 for a face value of 23, you could have used her entire 23 million to buy the commercial paper. Then on maturity date, you'll get something like 25 or 26 million, something like you can grow it like that. So just make sure you're not spending your capital, you're not taking risk with it, and you're earning a yield that you can live on. So this is one example. There are many different commercial people, and they're always available. The rates come and go. We're currently in a high interest rate environment, so you're getting high yield. Sometimes the yield will drop, but the product is there. And if you have some small bulk money that you want to put in a product like that and just get these periodic payments coming out, you can do that. This thing, I don't think it's as visible, but I want to show it because it's such a cautionary tale. This is an investment someone made in buying an apartment in the UK, student accommodation in the UK. I know the owner of this property, so it's not theory, and he was sending it to me to ask for advice. So I don't know how well you guys can see it. He bought this flat, I think, like £80,000 outright purchase. In the UK, they just told him, hey, look, you can buy this thing, it's student accommodation, students will rent it in the UK, whatever. Didn't do that much research, just bought it. Now, he gets this rent of £600 per month. That's the 600 number you can see on the extreme right. Next thing, see charges and charges. You see taxes. So this is the UK. Of course, the UK is so expensive when it comes to, look at the charges on this account. So he's got to pay, it said, I don't even understand what this is. So he's paying a service charge of 186, another service charge of 186, the management fee from the real estate agent that is helping him manage the property of 43. There was a replacement of something that got damaged in the unit for £82. Anyway, at the end of the day, his rent was 600. deductions were 620 in a single month. So his net gain was minus 20 pounds. And he gets this report monthly. I can tell you that this guy has never made up to 100 pounds on this investment before. And why did he do this? The guy, his wife, all this Team Jackpot, the husband is here in Nigeria. He moved his wife and kids to the UK and bought 2 of these properties. And his thinking was they will pay 600 pounds in rent each. So the wife is in another property, this student accommodation that he invested in. And his thinking is, let me make this investment. The income that is coming from these 2 investments, I'll be sending it to my wife and kids as upkeep in the UK so that I don't have to be converting naira to pounds to be sending to them every month. So let me have an investment in the UK where it's generating pounds income and I'll just be sending it to them. And the whole thing has been a disaster. There are some months where he will even be owing them money. There's a tenant there, the tenant's paying 600 pounds every month, but just between taxes and charges and all sorts of shenanigans, he doesn't make any money at all from this thing. And I feel like he's a bit stuck. So why do I show this example? Is just more of to highlight risk and to ask questions, understand the market, understand the dynamic. So yeah, somebody says, come and buy a property, you'll be getting rent of 600 pounds a month, and you just do it. Later you've done it, you now start finding out that there's service charge, there's management fee, there's tax, there's this, there's that. Some months they'll write him a letter to send them money he's owing, which is what happened in this month, minus 20. I've seen a few months with some positive numbers, but 80, 70, blah, blah, blah. But, it is what it is. Investing is not just about, they said I'm going to get this. Sometimes you can really get caught out if you've not really paid attention to the risk and what could go wrong. So on my next slide, okay, I think I came off. I'm sorry. I'm having technical issues. Let me stop and reshare. So I showed you the example of real estate in the UK and how that didn't work out at all for the guy. But I've also seen this example of US real estate. A couple of people I know did this investment. There's actually 4 of them that made this investment. They didn't want to take a mortgage. So 4 friends that had savings of roughly $80,000 each came together and bought this property for 320. It's in Houston. It's a 4-bedroom property. They get monthly rent of 2,000 net of fees. So each one of them is getting a dollar income of $500 on an investment of 80,000. So that's like 6 or 7% rental yield, right? So 500 divided by 80,000 is basically the fixed rental yield they're getting, right? And then hopefully they might get some capital appreciation. These are people in Nigeria, or 4 Nigerians. They're not just normal people like you and I that just accumulated some savings over time, and they did not want to get a mortgage. This thing is accessible to you, even getting international mortgages in the US. I know a lot of people that have done it, for people that are interested. So on this kind of property, for instance, exactly this property, if you do it with like a 200K mortgage, so it's 120K equity down, 3 people sharing it, so it's just a way to lock in mortgage. This one, the dynamics work better than the UK one. I don't know if it's just the specific city that they did the UK investment, but these are the kind of things that people are doing here, just to illustrate. So even with a mortgage, you would still be able to make some monthly income, right? So the mortgage of 200,000 at 9%, 9% is high, but rates are very high now. So that's just what it is. In a better environment, you might be able to do this and it will come down a bit better, right? and hopefully you get some capital appreciation on the property itself. Of course, the US real estate market will not have some of the difficulties that the Nigerian real estate market that I highlighted before, like opacity of prices, like no real liquidity, no transaction prices. Liquidity is much better in the US. People sell their houses. It's not that difficult. You can see real transaction values even online. Without having to do a lot of research. All of that data we don't really have here. So it's a bit more low risk. And like this particular property was a brand new build. It wasn't old house. So even when you start to factor in cost of maintenance and upkeep and depreciation, it sounds like a decent investment and it's accessible. Many of us sitting here in Nigeria don't necessarily know that some of these things are accessible to us. It's not that hard to do as a Nigerian citizen living here to buy a property abroad. It's not that tough. And it's a way to kind of lock in FX, especially if you expect to have long-term foreign currency liabilities like children going to school abroad and things like that. In Nigeria now, we have a lot of foreign currency funds some of them are fixed income, very low yield. There are those that you can do with a minimum of $500. ARM has them, United Capital has them, FBN has them, starting with $500, you can do it. We have a bit more sophisticated funds that will start with things like minimum of $10,000. And I've seen those that start with like $200,000. So I think there's something for everyone. Save a lot in Naira. But save something in dollars. I think it's important to have a portion of your savings. When I say dollars, I just use that as a proxy for foreign currency in general. So if you're someone that Canadian dollars is more accessible to you, use that. If it is GBP, use that. If it's USD, use that as well. And if it's Chinese yen as well, whatever works. But have some international diversification because our local currency has been, so unstable. So tech VC is something people talk about a lot. ARM ourselves are launching a tech VC fund open to retail soon. Again, that's going to have a minimum investment of $10,000. Tech VC is high risk. It's going to be a diversified fund, so it's not supposed to be as risky as you just kind of picking one venture to back. But at the same time, it's high risk, and it's good to know that. So that as you're thinking about, should I put money in this, or how much of my money should I put in this? Let's have in mind. But it's a new interesting area. Fintech's booming globally. So if you pick a manager that kind of knows how to identify the lights, so if you were one of those people that invested in kind of Paga or Paystack or, all those guys now that have become unicorns, but you don't even have to become a unicorn. So there are a lot of businesses that have grown in the fintech space, and those opportunities are also open to individual investors like you and I through a fund. And then you've got, African Euro bonds, local corporate bonds. Of course, we had this problem with Ghana recently, so we're starting to wake up to the risk of Euro bonds too. But, like I said earlier, you arm yourself with education and you should know what to do and what not to do, and you should be fine. So if you were to buy a Nigerian government bond, local currency, Naira government bond, you get like 15 or 16%. If you buy a Nigerian dollar bond, you get like 14%. So to me, it's a no-brainer, right? If you're looking to buy Nigerian bonds, you should buy the US dollar bonds because the risk or the underlying risk is actually the same. Like you're lending to the Nigerian government. So either you're lending in Naira or you're lending in dollars. It's the same credit at the end of the day. So if you're getting the same return in Naira versus the same return in dollar, almost the same, then clearly you're not being properly compensated for the risk on one side. So it looks to me that getting 14% in dollars looks better than getting 15% in Naira, knowing the history of the country. So I would do that. So that's an example. And that's a real life example that you can do today. Of course, many of us cannot buy federal government Eurobonds directly because of the amount of money needed to do it, but there are a lot of federal government Eurobond funds in the market and you can get it through that. So to do it directly, I believe minimum is $100,000, but to do it through funds, you could do it with up to $500 or $1,000. So just tips, and I think I'm just about to wrap up. It's a long game. Start early and just focus on the long term. Every investment must make sense in simple English. If people are describing an investment to you and you have to say, please say that again, then you know that maybe it's not the right thing to do. Investing should be simple. And then mentally prepare for ups and downs. It's never a straight line. So, like I was telling you, the lady that bought the commercial paper, a year or two ago, we're buying commercial paper 5%, 6%. Today we're getting 15, 16. So things come and go. Life is in cycles, market is in cycles. Just focus on the long term. Know that there'll be ups and downs along the way. And that return is only a reward for risk. You cannot grow your money by putting it in the bank, hiding it under your bed, not taking any risk with it. You have to take risk. The issue, and it's from that risk that returns come. So it's to make sure that your risk taking is educated, it's calculated, is well thought out. And then you cannot outsource your health, and you also cannot outsource your finances. You have to actually do the work as you would for anything else. The same thing for your finances, read, ask questions, talk to people, do your research, and hopefully you'll be fine. So without further ado, I've come to the end. I hope this was useful. Very, very happy to take questions. I saw 99 comments in the chat, but suddenly I see 3, so I don't know what I missed. But here I am, happy to ask questions. Back to the moderator. I don't know if how you want to do it. Do you want to moderate and
Yeah.
without the
Wow.
questions?
Wow. Wow. Like, wow. Thank you so much, Madam Abimbola. Like, this has been so much value. In fact, if you go through the comments, you'll be shocked. Like, you were just dropping it hot, like the kind of things that maybe we've heard some of these things, but I feel like the way you really explained them, and you were just talking very gently, but dropping some very, hardcore gems that made us think. So thank you, thank you, thank you so much. We are so blessed to, have had you on our invitation. So I just want to quickly summarize like 10 points I got from your presentation. There was so much to take away, and I'm sure that my sisters have been, jotting down so many things. We also we want to know if you can take your slides. Are your slides something that we can share in our group? Is that okay by you?
Yes, Nikki has the slides. I assume she already shared them up. Please feel free to share them.
Oh, okay, fantastic. Thank you so much. So to quickly summarize, you talked about how the best time to invest, like planting a tree was probably 20 years ago, but the next best time is today. So please, ladies, don't leave your money idle. You said that greed is an enemy of investment. So avoid, extreme risk that will lead you to significant losses. Then you talked about a jaw. Oh my God, at that point, some of us were almost crying, but yeah, you said it's only good when you collect early, because when you're collecting early, it's beneficial because you're kind of like getting an interest-free loan. But the last person who collects is like the one giving the interest-free loan. And it was so amazing because when I used to do a job, I always wanted to collect later, because I just felt like, oh, let me save up the money and then collect later. I didn't know that I was just being foolish. Anyway, then you talked about how we should stop doing charity. So stop doing more charity than you are investing. We need to be disciplined and have a budget. You said it's irresponsible to be helping someone's present when your future is not assured. Ah, that hits me. And when we talk about this charity, sometimes we don't look at it, things like buying a shwebi or somebody's getting married and you're contributing, like I'm on the group. And it's like an alumni group, an official alumni group actually. And all we ever do there is contribute. So the last time they came and said, we want to contribute for a wedding, and in my head, I'm like, hey, I'm not even in this institution anymore. Like, I'm not going to do this contribution because I had done some other charity and I was just thinking, oh, this is too much money to part with, right, in the same month. So thank you so much for that. We talked about how real estate should not be the foundation of your investment because it's really difficult to offset, and you don't really know the true value until you attempt to sell, right? You just carrying a property, you're thinking it's 70 million, but when it's time to sell it, maybe you're only going to get 30 million out of it. And you said children are not your retirement plan. So write a will. It doesn't mean you're about to die. We need to train our children to be financially responsible. And don't use a mental plan, have a written down investment plan. And above all, keep your eyes and mind on your money, like follow your money. You want to know what's happening with your money. Thank you, thank you, thank you so much, Abimbola. And I'm sure that there are lots of questions. So sisters, please, if you have questions, you have the option of dropping it in the chat or quickly raising your hand. I know that Brenda had made a comment. I think she wanted to contribute to something you had mentioned. Brenda, do you want to go now or? Hello? Is Brenda on the line? Okay, I don't think she's ready. So let me quickly call those whose hands are raised. I have Uluwa Yomi. Please feel free to unmute your mic and ask your questions.
Thank you so much. Thank you. If we're well done. Good evening, ma'am. Thank you so much for dropping it like it's hot. That's basically what I can say. Okay. So I have a question concerning having an account with a business like ARM. I actually have one, but from what you've said, it seems like I will have a better understanding or make a better decision with my portfolio if I have a personal relationship with whoever is doing my accounts. But that is also very difficult because what ARM does is they just send me my statements every other month and just a digital, an automated number. So how do I get more of my portfolio in ARM? Thank you.
So ARM, we provide different levels of service. So there's a simple brokerage account, which is for self-directed investors. So I know what I'm doing. I just want to be able to buy stocks, buy bonds, and I need an app or a portal online to do it by myself. We have that service. So it sounds like that's what you have. It sounds like, but I don't know. But you could also open a personal wealth management account where you have a dedicated relationship manager. Your relationship manager is going to come to you every quarter to talk about your statement, like sit with you, handholding. So all of these things, there's like minimum value, but it's not really around, so to have a personal dedicated account with financial advice and a relationship manager, I believe maybe the minimum account value might be 20 million naira. I don't know. I'll share my contact so I can follow up and get to you. So remember, I'm now at ARM Pensions. So I only work on the pension side of the business. But ARM Investments is our whole core, is part and parcel. We're the same, but it's just a different arm. So I don't know these numbers off the top of my head. But I know that the thing is that for you to have this bespoke dedicated service, they'll say you need to have a certain amount of money. Because otherwise you cannot provide kind of bespoke RM to hordes and hordes of clients. So if you want something that is more bespoke, more targeted and tailored, I would say look to see if you can open that kind of private wealth management account, which is what we call it with ARM. Then you'll get a lot more guidance, a lot more handholding. But we will find that there are a lot of people that have hundreds of millions that don't want that. So it's not really that this service is for rich people, this service is for people that don't have money. No, it's really that there's one service that is for self-directed investors who decide on their own account that I want to do it by myself. Because with the self-directed investors, you're not paying any annual management fee. So if I have a brokerage account with ARM and I'm just using that account to buy GTB shares, do this, do that, ARM doesn't really charge you anything to do that. But if you have a private wealth management account, there's this 2% fee per year that you pay to get the advice and the bespoke services and all. So some people decide I can do it by myself. I don't want to pay the fees. Some people say I need help. I'm happy to pay the fees. And each of those accounts have different account opening criteria. So we can follow up with that later if that's something you're interested in. Yes.
I have another follow-up question. Now, I have a father who is a pensioner, and I'm also managing his accounts. So is this the kind of the pension wealth manager account I should look at in trying to increase his portfolio?
Yeah. So, the pension scheme that we run, this is the government's contributory pension scheme. So it depends on what kind of pensioner your father is. So for instance, my dad is a pensioner, but my dad retired from the military. So he's, so their own pension, there's a way military, they do their pensions. They don't put their money with PFAs. They pay them directly from the government, just the same way the government is paying people's salary. So I have nothing to do with my father's pension. I don't even know, But my mom retired from Nursing and Midwifery Council. So she was using PFA, she was contributing. So she's in the contributory pension scheme. So I'm able to look at her account, add value, give her advice, things like that. So not all pensioners are equal, So pensioners from all those independent oil companies, them Shell and Chevron and Co., they have defined benefit pensions. So what kind of pensioner is your father? What kind of assets are you managing for him?
He's a professor. He retired from the
university. So, who is his PFA? The contributory
Yeah.
pension scheme is very regulated. Let's touch base offline. If you have any questions for me,
Okay.
whatever I can do to help, I'll do. But you'll find that the contributory pension is very regulated. So anything you want to do for your dad, you'll be doing it kind of as an aside. But within the pension scheme, there's not that much flexibility beyond opting for either a program withdrawal or an annuity. There's not much more that goes to it beyond that.
All right. I was even talking about expanding, increasing his portfolio.
So if you want to
not
expand and
necessarily
increase
the
his
pension.
portfolio, fantastic. So you do that outside of his pension account. So you do like a separate investment account for him that now manages his non-pension assets. So he already has a PFA managing all his pension assets. Then you can accumulate his non-pension assets in a separate account and then help to manage that way. So that makes sense.
Thank you so much. I will be waiting. I would love to get your details so I can discuss later.
I'll be
Thank you
very,
so
very happy. I'm not super responsive, but I do everything I can. So like Nika will tell you, you can message me, I might respond tomorrow, but I would definitely respond.
That's perfect. Thank you so much. Thank you so much.
No problem
Thank
at all.
you so much. I think the next person, Sis Chinebe, do you want to unmute and ask your questions, please?
Okay. Thank you. Good evening.
Good evening.
Good evening, ma'am. Thank you so much for this very insightful session. I enjoyed every bit of it. So please, my question is around real estate. Personally, I've never really been a big fan of real estate. When I started to invest, I did mainly, or still do mainly equities, not so much fixed income and all of that. But I wonder your thoughts as to going for commercially viable land through registered real estate brokers or realtors, what your thoughts are, because I was reading about someone's testimony just yesterday or so. It's a guy I follow and been following him for a while. So he's transparent and I believe he's honest in what he says and he does. So anyway, he mentioned that he invested in Abuja last year. He put in about 10 million in this, he bought a land of 10 million through a proper real estate broker. He even dropped the name of the company. And so just last week or so, the broker called him up and asked him if he wanted to know the current value of the land and if he wanted to sell. So he was told that its current value is going for 17 million. And this is someone that put in 10 million last year. So this is about 40% increment from last year.
70%.
About 70%, sorry, from last year. And equities will not give you this. Definitely not, I don't know any corporate bonds or commercial papers or corporate bonds that will give you this. But this is what he was going for and I was wowed. So you talking of real estate, I just wanted to know if it's okay, what your thoughts are about buying commercially viable lands through all these registered real estate brokers and I mean, what you think about this increment, this ROI that he mentioned? Is it something that that actually happened? Is it believable? And yes, what are your recommendations?
So
thank you.
I think thank you. Great question. I think at the end of the day, just like the London property I showed you, right? Verify, ask questions. I mean, the example you gave, is it possible? Yes. Do we know? Is it repeatable? Right? The fact that somebody bought it 10 million last year, he can sell it for 17 this year. The person who buys it at 17 this year might not be able to sell it for 30 next year. Do you understand? So they've been in the right place at the right time, doing the right thing, right? So it's not as if markets cannot go up 70% every year. You get what I'm saying? So obviously that guy caught the upswing and caught it at the right time. If you try to go and do it now, will you get 70%? Maybe you will, maybe you won't, right? Yours might be higher, yours might be lower. You want to be educated. What I would say is that I have found that trading land or buying real estate, I've done 1 or 2 or 3, and they work. The critical factor is the integrity of the person you do it through. At the end of the day, that's what it boils down to eventually. Somebody else will buy land on the same street in the same neighborhood and he will lose his shirt. Somebody else will buy land on the same street in the same neighborhood and make 70%. And the difference between the two is the person he bought it from. You go and buy your own from someone who is selling his grandfather's land, but the will is not in his name. You would have bought it. Then the family will come and sue you and say, you say they're registered brokers. Some registered brokers are upright, others are not. So do your due diligence. Word of mouth is not enough. My friend told me that is not enough. That's just what I'll see. If you want to make 70% return, you should be willing to make some investment towards getting that return, right? If the little investment you're going to make is buy a ticket to Abuja, go there, look at the place, look at their office, come back, it's worth it. You can't do it from your desktop. I would not advise you to do that, So to put in 10 million and get 17 million is worth you spending 400K on due diligence. It's worth it. If between that, the 400K is your transport fare to go there, is hiring a lawyer to check, is trying to get independent DD, like all that. Abuja, be very careful because Abuja was a planned city, and over the last kind of, I would say 16 years, really, like all the Jonathan years and all the Buhari years were years of nonsense, right? People were just doing all kinds of madness. So if we continue the way we are, maybe nothing will happen. But if by mistake, we just end up with one administration that has sense, a lot of the things we call Abuja today, they might run into trouble, just like what was happening when El Rufai was FCT minister many years ago, right? You just find out that they'll say, you have to demolish all these things. Like, who gave you permission to be doing all this here? Like, Abuja is a really planned city. And it's kind of gone to the winds. Is now everybody's just doing, it's an all-comers affair now. Everybody's doing whatever they want to do. Make sure you don't get caught in, so like I said, invest some money into doing some investigation, find out what zone the land is, find out what the original design, what the original purpose of that land is, Abuja's master plan. Don't go and buy land where they've already said a bridge is going to pass there, So just do some due diligence. It's never enough that one of my friends told me that for you to put 10 million in anything. So you might do your due diligence and just find out that it makes sense. Then it will be worth it to kind of see of what do they have. Even some things that are legitimate, you will see all kinds of complications in this Nigeria. Ikoyi land today, you buy land because federal government and Lagos state government, they're doing one funny fight in Ikoyi. I don't know if you guys are aware. So it's not only about when 419 bars you that you can lose money. In Ikoyi, if you buy land with federal C of O, Lagos state will not respect that federal C of O. They'll tell you to come and collect Lagos state C of O and do like a fresh registration or something crazy like that. And you might find out that you will just basically buy the land twice. That's pretty much what ends up happening. And that's why, if you notice, just keep an eye out when you see brokers advertising things. When you see Lagos Ikoyi land being advertised anyway, you'll just see they will write federal C of O, Lagos C of O. What does that even mean? A lot of people don't even know the difference, and you just think that it's just footnotes. It is very meaningful because you buy it with federal C of O is legitimate, there's no issue, but between two elephants fighting, you just get caught in the middle, and they'll say, oh yeah, come back to Lagos, they come and register the land, and you'll find out that the amount they're telling you to come and re-register is almost the same amount you bought the land, and you're paying twice. So those kind of things happen. I don't want people to feel like it's only integrity that is the risk. Sometimes they're just other things.
It's beyond your control.
Yeah, and so just be aware of what the issues are, what drives, that vicinity and all that sort of thing.
Okay, thank you, ma'am.
Yeah, thank you.
Thank you.
Thank you so much for your answers. Sis Chama, do you want to mute, please?
Yes, I want to unmute.
You've got
Good evening.
Yeah, ask your question.
Good evening. Good evening, ma'am.
Good evening.
Thank you so much for the wisdom that you dropped this evening. Please, my own question is around pension. So, please, I'm trying to find out how I can collect my money from my pension administrator. I haven't I haven't contributed pension in, say, at least since I think July 2020, right? So even if I go there now and say I'm not working, I will collect money, and I will not be, I'll be lying, but I will not be lying because I've not contributed pension. Please, how can I legitimately collect my money? Two things is the reason. One, for example, I want to go to school now, right? And I have money sitting in pension that I honestly, I might be wrong, but I don't see the value of having that money sitting with Stanbic IBTC, and they are telling me, oh, you made 2 naira, then you now lost 15 naira. And I'm wondering why. Whereas, let's say if I had that money, with the information I've received tonight, I can say, you know what, okay, let me just use this money to do this, and then get this back. Now I want to go to school. I'm looking for money up and down, and I have money sitting with Stanbic IBTC. Please, is there a way that I can legitimately collect my money from Stanbic IBTC? What are the loopholes in the
There's
law
no loophole.
that can
So let me answer. Trust me, everybody's in your position, and it makes me sad because you people. I work in the pension industry. The pension industry doesn't exist, and I'm out of a job. So we want to keep the pension industry growing and viable. So there's only one way to collect money from your pension account. The maximum, you can collect is 25% of whatever is in there. So long as you are not yet 50. If you are 50 years old, you can say early retirement and start collecting money. Even with the early retirement, you cannot collect your total balance in one day. You can collect 25% of it and as a lump sum, and then collect the rest as a monthly payment. If your balance is very low, i.e. minimum not more than 1 million naira, you can collect everything at once. So long as it's more than 1 million naira, you cannot collect everything at once. If you have been not working for more than 4 months, you have the legal right to go and collect 25% of whatever is there. The rest of it is when you go to retirement. In the chat room, somebody said pension is a ripoff. It really is not a ripoff. It has its flaws with the way it is designed, but it really is not a ripoff. I can tell you that many people who have worked in the private sector, so they live, if you are not working for another company and you're not working for Nigerian government, there's nothing for you in this country. So for many of us, we have options, so we can say, give me my money, I know what to do with it, I know clinical, but there is a vast majority of our population that this regulation has helped significantly. So you're a teacher teaching at a private school, you're an employee of a state government, not just federal government. All of those people before, they work 35 years, and at the end of that 35 years is bye-bye. Now, your employer is forced to contribute on your behalf. It is something you are getting that you would never have gotten before. For your employer to be forced to contribute on your behalf, you also have to contribute something. Even if that money is not growing at all, it's better than nothing. Now, the industry exists for us to take the contribution from you, take the contribution from your employer, and try to grow it for you. Just achieving exactly what this whole lecture was about, that it doesn't matter, it's the consistency that matters. And trust me, all those people fighting like, give me my money back, they don't have anything else anywhere. This compulsory saving is pretty much all the saving that most people have. And they don't even like the fact that the government is forcing them to do it. But for many people, that's all they're going to have when they retire. So the big flaw of that scheme right now is that we're not able to invest the money in a way that, really grows, that makes people feel like, there's value, see how my money is growing. But that's not a fault of the pension fund manager. As a function of the economy is so challenging. We all know it. You've seen people, it's so tough. So if things get better in the country, you will see that the returns on the pension investments will improve. And I think that having this compulsory savings scheme is such a great social safety net. We don't have child benefits, we don't have unemployment benefits, we don't have any free healthcare, we don't have anything. So to give to people that are turning 55. that, you know, just worked as a clerk in a university, you know. So even if it is 5,000 naira per month, 10,000 naira per month, it's enough for people to be able to eat, not to live in poverty in retirement. It might not be able to give them a great life in retirement, but it's performing a role. So I don't want us to throw the baby out with the bathwater. So with my sister that hasn't contributed since 2020, approach your PFA. You should be able to withdraw 25% without stress, but you cannot take more than.
Thanks so much, ma.
Yeah.
Thank you so much for that response. I see we have another question in the chat, and Sizvani is asking, which of the dollar investments with low risk would you advise one to go into, please?
You can start with the dollar bond fund. Many asset managers have it. ARM, Stanbic, FBN, United Capital, Chapel Hill. Choose anyone you like. They allow you start with $500, and just start from there. $200 per month. Do, you know, just start gradually. It's not, they won't double your money overnight or anything, but it's a nice, tidy, just be doing it there, you know. Remember, that's another key takeaway you can take from today is consistency is what we're after. You don't have to be doing a large amount. Just do it consistently and you'll be surprised what, you know, will come out of it eventually. So they're fixed income funds. So Euro bond fund, they call them dollar bond fund or Euro bond fund.
So is it possible to give us a contact to like the ARM investments person, or
I will circulate some good contact numbers for you. Somebody said, I'm just reading the chat, somebody said there's a new policy that one can access 25% of your pension as equity for mortgage. That is true. It only just started. This 25% is the same maximum you can take out is 25%. So either you take it due to unemployment, or you take it for mortgage, or you take it for full access. So for someone that has taken 25% because they were out of job for 4 months, you are not going to be able to come back and take another 25% for mortgage. So it's not, you understand, it's not 25 year, and before you know it, you've gotten to 100. No, the maximum anybody can take out of their pension for any reason is 25%. So you can either do it through the mortgage channel, or do it through the unemployment channel, or do it through the early retirement channel. But it's still that same 25%.
Oh, sorry, Bimbo, but that's not actually what I heard was that if you are taking the 25% before, that if you can still do 25% for pension, for mortgage.
For mortgage.
That's what I've heard.
Okay, I would cross-check that for you. That's not my understanding, but I will double check and get back to you.
Because me, I want 100%, Sha.
It's not possible.
In case you're making those, please.
Just hurry up and turn 50 and then you can take your money.
Thank you.
No, sis, but even at 50, right? Are you going to take your money? Or they're going to be paying you?
And you get, yeah, but you can go buy an annuity, but even an annuity, you're not going to take it bulk. They'll still pay you monthly. You take 25% and they'll pay you the rest monthly. Sisters, this is an investment and saving forum. This is not how to chop my money quickly forum.
I want to deliver my money. Let me know that.
No, but it's true, because if I leave 75% in there, when I turn 50, let's say I've already taken 25%, luckily, because I relocated, so I can take my 25%, or you're in a business, you can take your 25%. I've not even taken my 25%. That one's a story for another day. Those ones are just sending me mails and not answering me. But that's not the conversation for today. The remaining 75%, I turn 50 and you start sending me what, 10,000 naira every month. What's that gonna ever do for me? Give me my money.
If you feel like 10,000 is too small, then contribute a lot more so that your monthly payout can be higher.
I don't know what it's going to come to, but I'm just thinking in my head. So how do they even calculate how much you should earn every month? For like how many years do you plan to pay? Is it like till you're 70 or till you're 80?
Beautiful question. We assume 80 for men and 82 for women, because women on average live longer than men. It's statistically proven.
Okay, thank you so much. Let's not attack you. You're not the one who, you know.
No, I'm not the one. Is there any pension security provision for entrepreneurs and SME owners in Nigeria? No, we have an option for you to join the pension scheme voluntarily. So it's not compulsory. But there is an option if you want to do it to join any PFA and contribute. And when you contribute under the scheme that is not voluntary, there is a bit more flexibility in collecting your money back. So for people like us that are in the compulsory scheme, all this, you can't take more than 25% is the rule. But if you come in as an entrepreneur or as an SME owner, you contribute, you can take your money after 3 years. Like the opportunity to take your money back is a lot more flexible. That's what I would say. So that's the answer to, I think, Omolara O. Ayodeji Fatoye has hand up for a while. Let's see.
Oh, sorry, Ayodeji, please go ahead.
Okay, thank you so much. Good evening, everyone. Good evening. Thank you so much for the training. For a while now, I haven't contributed pension. So, and I'd been thinking about like asking someone how to go about it. I want to start again.
Are you in formal employment?
Yes, but my office, we don't pay tax. We don't tax us. We don't do pensions.
Okay, so you just want to contribute on your own?
Yes.
Okay.
I'm already signed up with Sterling Pension.
Crusader Sterling.
Crusader Sterling. Thank you so much.
Yeah.
So is it a matter of just contacting them and continuing with them?
So you cannot have, so there are two schemes. There is a compulsory scheme, which is the account you already have. And in that scheme, you cannot put money into that account by yourself. It should come automatically from payroll. So if your company is not contributing, you cannot say, oh, I want to contribute by myself. Well, some things that some people do is to tell their HR, please contribute for me, although they don't like to do that, is even if the company doesn't want to do their own portion of the contribution, deduct my own portion and put it for me because, I want to save, I cannot do it by myself, HR has to do it. So the reason why HR is not doing it is because the employer does not want to pay their own portion. But if you as an employee are willing to pay your own portion, you might have that discussion with your HR to say, can you at least remit my own contribution? But when they start remitting your own contribution, that's when the PFA will see that this employer is not compliant and they can get into trouble for that. So that's the reason why employers don't like to do it. But that's the only way you can do it. If you want to contribute for yourself, you have to open one of the non-compulsory accounts to contribute for yourself. What I don't know today is if you already have a compulsory account, can you also open a non-compulsory account? I don't know that for sure. My guess is no, you cannot, because the pension database is the same and we use biometrics. So the minute you put your biometrics in, we will see that you already have an account in the formal sector. Therefore, you cannot have an informal sector account. So that is the risk, or that is the challenge I'm struggling with in my head, because I doubt that it is possible. But let me go and dig more for you and get back to you. So, because the only way to contribute by yourself is to open an informal sector account. In a normal compulsory account, you cannot contribute by yourself. Your employer has to contribute for you. Even when you want to do additional voluntary contributions above what the government says you must minimally contribute, it must still come from your HR, from your payroll. You cannot do it directly from your own bank account.
The thing is, I work for ECOWAS.
Okay.
They don't tax them, they don't pay tax, we don't.
Yeah.
So it's not going to come from them.
So the account you opened with Crusader Sterling, this was before you started working for ECOWAS. That's what the issue is, right?
Yeah.
Right?
Yes.
Okay, so what you might then be able to do is you will be able to convert, if you're willing to, your existing account to a micro pension account.
Okay.
Yeah. So call your PFA and tell them, I'm now working for ECOWAS. ECOWAS is exempt. They don't contribute. I want to start contributing. Can you convert my account to one where I can do my contributions by myself? So that would then be a conversion, which is easier. Because I was assuming you were working for an employer that was mandated to contribute but didn't want to. But if your employer clearly is not in any infraction, then you can convert your account to a self-funding account. So talk to your PFA.
Okay. All right. Thank you so much.
Yeah.
Thank you so much. There was a question from Priscilla where she was asking, what about piggy vest investment in dollars? I don't know if you have any idea or information about that.
So I don't know much. The only thing I would say about piggy vest is that, they're a fintech, they're not regulated in Nigeria. So I prefer regulated entities because there's just some basic baseline. Piggy vest has been around a long time, and I feel like they're everywhere enough for us to know that they're not trying to be a fraud or whatever. But as a matter of principle, I just prefer the regulated entities. That might just be biased. So I don't think there's anything wrong with it. But if I had the option to do a dollar investment with PiggyVest or do a dollar investment with Stanbic, I would do it with Stanbic, me personally.
Yeah, that makes sense. Thank you so much. Adenike, please go ahead.
Thank you. So I was just going to kind of chip in when Ayodele Fatoye was talking. So if I was in her situation, for example, and my employer was one of those fraudulent people that don't want to pay, if I decide to register my own company and I ask that so now I now work for my own company and I'm asking Crusaders to then begin to charge me there, is that something that I can do? Is that an option?
You can, but your own company you're registering has to be a real company. It can't just be like some shell that you created for this purpose, because for a company to be registered, you would need your tax ID, you would need your, because the employer is registered on PENCOM's portal just like the employee. So if your company is a real legitimate company that has everything that a company in Nigeria should have, then absolutely, yes, you can do that.
All right.
But if
if it's my friend's company. Okay, what if it's my friend's company and I ask to become their employee so that I can capture this? That's an option.
Yeah.
Okay. Thank you.
Yeah.
Thank you so much. I can't see any other hands raised, and I cannot see any other questions in the chat room. So I guess, do we have any other questions, please? Maybe last minute questions, or anybody still wants to ask anything? I guess not. Thank you so much.
I'm sorry. I finally got away from the noisy place. I just wanted to chip in something. I know we've been here long, 2 hours. My goodness, we're so sorry, Mr. We're not normally like this. Please, but your class was really interesting and very, very loaded, very informative. God bless you. I'm an architect by profession, and I presently run a real estate company. I just wanted to chip in something in the real estate you were talking about. And so I said, yes, you had a very good example. In fact, the example you gave happened to one of our family friends, who had built a house in Okoba, and by the time they were moving to Lekki, they couldn't sell the house. It was just there forever. We had built a house in Ogba, but luckily for us, the government just did a new road in front of our house, so it increased the value, and so we're able to get something. But on this flip side, we bought a plot of land somewhere at Lakawe, right? The plots of land were 11 million each. And by the next year, somebody was begging us to flip it for 20 million. And we're like, no, we're going to hold on to this. So I think the rule basically is not houses, but if you want to do real estate for investments, don't do houses, do land. Land is easier to let go of, and you can get better money from it. Now, but when you want to do land, you have to be careful that it's not Omonile land, because Omonile will sell it to somebody else, and first to build in Nigeria, possession is Nigerian law. And also you also have to make sure that you have the full papers, look up for a lot of things. There's just a lot. Basically, the bottom line is get a professional that will help you check the things that you don't know, and at the end of the day, you can make money from investing in real estate. So yeah, thank you
so much. No, that's great insight, great addition. Thank you. One of that experience I've had with things that have worked for me, again, there's a huge kind of quality control element you have to have, is buying development off plan. and then selling them when they're fully built in
Yes,
high
works.
quality areas. Yeah, if you find the right developer that wants, that
That
has a
will-
good track record,
That will
wants
actually deliver the house.
Yeah, exactly. I've been lucky. I've done it 2 or 3 times with a group of friends. We've been really lucky. There was one we did in Ikoyi. In 2019 they started and they finished last year. So it was supposed to be 18 months. It was 3 years. By Nigerian standards, that's great, right?
They've tried.
yeah. And we bought 150 million off plan. And immediately they finished building end of last year. And the good thing about off plan is you're not giving anybody 150 million in the beginning. It's milestone.
You're going to be paying,
and the more delay they have, the more spread out the payment was. 3 of us came together to do this thing, bought it for 150, and now sold the property for 350 in December.
Amazing.
From 2019 to 2022.
Yeah.
So if you find a good off-plan developer with a good track record, that's another way of making money.
Absolutely. Absolutely. Thank you. Thank you so much.
Wow, this has been so much value. Thank you so much for that addition, Brenda. Thank you so much. So I think in the absence of further questions, because we stayed here for like 2 hours plus, which is unprecedented. But I mean, we had you, so we just had to extract as much value as we get from you. So please permit us, we might be coming back again, because there were a few things you said at the beginning of the training that caught my interest, and we might just come back to you to come back and tell us more in that regard. But so that we don't keep you much longer, because you have like children to take care of and other family responsibilities. And I mean, this was free of charge, so let's not overdo it. I'll just quickly hand over to Abby to give us the vote of thanks. Hopefully Abby is on the call though. Is Abby still on the call? Because I didn't even check. Yeah, Abby's on the call. Hi, Abby. Are you with us?
I'm here. Yes, I'm here. Good evening. Wait, give me 1 second while I try to find a quiet place. Okay.
Oh, sorry about that.
No problem. Thank you so much, ma'am, for coming to share the knowledge with us. We are grateful. Again, like my wonderful and beautiful assistant says, we're sorry for keeping you for 2 hours, but where value is, we are all here with our pens and papers, and I've written so much down. Thank you so much for sharing. I spoke. Okay, sorry. Okay, in the future I'll address you, but for now, your value is what I'm using to give you the title, the value that you're giving us this evening. So thank you so much. Thank you very much, and God bless you.
Thank you.
And we look forward to having you again sometime in the future.
Yeah, I think I might just join this club. It's like
Please, we want you already.
You're very welcome.
No, I would love to.
Please, you would not regret it.
Let me give Bestie application. You see in this group, people always
excuse you. It's my turn to talk. It's my turn to talk.
Applied to be your
It's my turn to talk.
No, it's great. Like women supporting women. I'm all for it.
Please, you will not regret it.
Haram is allowed.
Thank you.
Sisters for staying for so long, right? I mean, I'm sure it was just about the value, but thank you everyone for making this happen. Thank you, Adenike, for connecting us to this wonderful personality.
Yes, Adenike, flowers for you.
My shoulder pad is high. Thank you.
I'm
going to just log out now. Good night, everyone. Have a lovely rest of the weekend. Bye-bye.
Bye.
Thank you so much.
Thank you very much. Bye.